Ladies and gentlemen, please welcome Bo Hale, Managing Partner of Pine Peak Partners. Prior to founding Pine Peak Partners, Bo co-founded Mitigator, which was acquired by Equifax in 2022. He also co-founded AdBoom Group, which was ranked third on Forbes' list of most promising companies in 2015. Today, Mr. Hale is the managing partner of Pine Peak Partners. Bo, welcome, and the floor is yours.
Thank you, Chantal.
You're welcome.
Yeah, and as she mentioned, if there are any questions that come up, please feel free to, put those in the chat. I think it's more natural when those questions come up along the way, and not saving them until the end, especially because others may have those questions. I'm happy to be here. It seems like we have a lot of folks in here. We invited some of our investors and partners, which I think are also part of this group, and I'm sure there's many others that we don't know that we'd love to get to know. So as she mentioned, I'm the managing partner of Pine Peak Partners, and I've been to the Money Show before. It was in Philadelphia, I think in 2019. So I was at a physical show, never been to a virtual show, either both as a host or a guest. So hopefully you get something out of this. I do think it's a little bit unique because most of, I think, the hosts that are in the Money Show, both physically and virtually, are typically having to do with, in some way, shape, or form, the public markets. We're very much in the private markets, and our category, our sector is real estate. So kind of dive in here. And let me switch the slide. So this is a quick disclaimer. I don't expect everyone to read this now. The deck is obviously going to go out, and it's in the virtual room as well. You can grab this, but I'll just kind of pause here for 20 seconds for everyone to read this over, and then I'll move to the rest of the presentation. Okay, so a little bit about me. I am the managing partner of Pine Peak, as I mentioned, Chantal mentioned. My background, which we'll go into on the next slide, we'll kind of do a deeper dive on that. But I think it is important for me to introduce myself. Usually when I see investment decks, they usually do this at the end. You see the team, but the way that I invest my own money, it's very much people first. So I want to know who the people are, because whether it's technology, it's real estate, it's public markets, the people that are steering the ship are the most important aspect of the business, in my opinion. You can see here, I've generated a collective enterprise value of 400 million in my various businesses, employed well over 1,000 people in my business life cycle, not at one time, but through the decade plus that I've run my businesses, and an estimated around $50 million in economic impact. What I mean by that is, through employing people through the various businesses, it's kind of around that $50 million impact there. I will say, both on this slide and the following slide, I can't take 100% credit for this. I did have two business partners who are my very best friends, also business partners of Pine Peak, which I'll kind of show you them at the end. But this wasn't me solely. I did have two guys that have been part of my business life here. So we'll flip to the founder timeline. There's a lot of information here. I'll kind of just touch on some of the major points and how this sort of translates to Pine Peak. So in 2011, me and my business partners founded AdBoom Group, which in 2013, we reached to over $100 million in annual revenue. And that kind of continued throughout the business, a little bit variance between a little sub 100 million and many years that were over. What overlapped with that was in 2014, we founded Mitigator, which was a fintech platform, and AdBoom was more of a ad tech platform. AdBoom, as Chantal mentioned, was ranked number 3 on the Forbes most promising companies. And then in 2018, there's LLR partners, private equity partners, that invested $30 million into Mitigator and its growth. And then eventually we sold Mitigator to Equifax in August of 22. If you look at the top gold box, this is really more the timeline and how Pine Peak came about. So in 2015, I did my very first passive private credit investment. Really fell in love with the asset class, and due to some of the characteristics, which I'll go over in some of the next slides. In 2020, had my first hand at doing my first direct bridge investment. it's a long story. It's a great story. Don't have enough time to go over it here because we are tight on time. But it really was the genesis of Pine Peak, which we started in 2023. So here we are. It's a guy that has a life in technology that is now an asset manager in private credit. It's all, kind of a long story how I got here, but I think I'll cover it in these following slides. So in this session, I'm operating under the assumption that there's some folks that are in here that have never heard of bridge debt. So I'm not saying that consists of everyone here, but I am operating that assumption. So I am going to make some very basic explanations so that everyone can kind of track what I'm saying. If you look at the risk level of payment here, you can see senior debt, preferred equity, common equity. There's low to high, right? We are a senior debt provider, so we do effectively the same thing that a bank would do. We lend money and we have a first lien position as collateral in our real estate transactions, and we're 100% real estate focused. You can see here in the middle, preferred equity. They're more kind of that medium risk of payment. You may or may not be familiar with preferred equity, but they are in that middle of the capital stack. They get some preferential treatment that the common equity doesn't, and still not having the same level of low risk that a senior debt provider would have. And then there's common equity, which is the folks that if they're buying a real estate building, they're utilizing senior debt. They may or may not be utilizing preferred equity, but they're really the true ownership of the building, and they get obviously all the upside, but they do have the downside with the bank or a preferred equity partner sitting in front of them. This risk level of payment is not just in real estate. This is done in many shapes and forms when it comes to lending, both in private credit, and corporate debt, many different things. It's not strictly in relation to real estate, but just to give you an idea and a really basic understanding of what we're saying, how to be the bank. So how bridge debt works, I think this is a pretty good visualization of how it works. But before I do that, I want to explain, why people or folks use bridge debt. So if you look at the name bridge debt, it really is acting as a bridge from one part of the cycle to the end, right? And the end of that cycle, when you reach the end of the bridge, you're really trying to chase permanent financing, which is banks, right? So it could be your large institutional banks like Chase, Bank of America. It could be your small local regional banks, but really permanent financing, you get the cheapest debt, right? So in today's market, it could be 6-8%. We are a more expensive capital provider because we are serving as that bridge so that they can get to that permanent debt financing. So now talking about how it works, it is effectively the same functionality as a bank, right? So we left preferred equity out of this presentation just for simplicity. We just have the senior debt, which is us, and then we have the common equity debt. So if you have a $10 million asset purchase, the funding source would come from us, right? So at 6.5 million of that would be a loan. That would be underwritten at a 65% LTV. Sometimes it's less, sometimes it's more, but just using a basic example. So if we came to the table and we lent $6.5 million, that means the common equity provider would have to come to the table with $3.5 million. If you look at the return profile, we underwrite our opportunities in today's environment, right? Where rates are relatively high, they're coming down, but we underwrite our transactions to be a 12% net return to our investors, and to distribute those funds every single month, because we get paid every single month and we return those payments to our investors every single month. If you look at the return profile on the common equity provider, they have really no sky's the limit, as much upside as they can capture, but it's typically around 18 to 20%, sometimes less, sometimes more, like I said. The risk reward, so we're the first to be paid. So you always have to pay the bank first, and whatever's left over goes to the common equity providers. So we're first to be paid. We have the first lien on the property. So if the investment goes south, obviously we have that collateral that we can capture, and we can obviously sell the property, manage the property, whatever we decide to do. The common equity providers are always the ones that are last to be paid, right? So you got to pay the bank first. Then you have your other things like your general expenses, property taxes, insurance, things like that, right? So really it's paying the bank comes before all those expenses, then you get all the other expenses that go to run a building on top of that. So why bridge debt? So this slide is maybe the most simple slide in the entire presentation, but I think it's the most important because this really encapsulates for me why it was that I wanted to start Pine Peak. It's these three key characteristics right here. So attractive risk-adjusted returns to equity. So, if you think about the returns that we are getting and continue to get 12%, that's great, right? I mean, that's a solid return even when it's benchmarked to the S&P or other investment classes. But at the same time, you always have that downside protection by owning the underlying asset, right? So debt always gets a second chance and equity does not. So what do I mean by that? So if you had or if we had an investment or an asset that was in jeopardy, we always are underwriting this to a conservative LTV, so loan to value, right? So in that example of showing you how bridge debt works, at a 65% LTV, we are lending our money at that 65 cents on the dollar, right? So if something were to happen to the investment or the asset, well, we can foreclose, we can take over the asset, and we can liquidate the asset. So, if you're buying something at 65 cents on the dollar, can you move that quicker than buying it at 100 cents on the dollar? The answer is 10 out of 10, always yes, right? So we always get that second chance to recapture our investment. Our investments are never going to go to zero. And then one of the things I love the most about what we do is that bridge debt provides monthly cash flow. So, when I first started working with some of these other firms, although I didn't think that their reporting was great, and there were some things that I did not love about the operational side of their business, which I can kind of get into as we talk about us. I loved that the money showed up in my bank account every single month, right? Because it was doing what it was supposed to be doing. It was generating cash flow, and that's obviously speaks to me. Some people are fine, with longer time horizons and their money being, locked up for 1, 2, 3, 5, 10 years, right? But I really love the fact the cash flow characteristics. So, the bridge debt. I think it's for me personally, and maybe it resonates with some of you on here as well. This is really, what the three key characteristics that I love about bridge debt, which is why, I wanted to make it simple and kind of speak to you guys that way. So, wealth preservation and wealth creation. This one's kind of interesting because when we were first launching Pine Peak and very early into that process, I really thought of us in that wealth preservation bucket instead of that wealth creation bucket. But when you think about it, it really captures both, right? We really do both those things because we have that wealth preservation. We are the first lien provider on the underlying asset at a really low LTV. But we're also creating wealth, right? I mean, if you're thinking about a 12%, net return, 12% plus net return on an annual basis, you can create a lot of wealth doing that, and it's a great return. And again, benchmarking this to the S&P and other things, you can make a good living doing that. And so, why we do it, we target the downside protection. We always want to make sure that our capital is preserved. And we're being conservative in the way in which we deploy the capital. And so, that really comes down to these four things at the bottom, right? We have the first lien on the asset. We have the low leverage. We've done, as low as 27% LTV on some of our transactions. We really, I think, done as high as 68%. So we're really trying to capture as much low leverage as we can so that, we have that protection characteristic. And then the attractive collateral. So we always ask ourselves, would we want to own this asset? So before we close on any single transaction or even on the early stages of evaluating the assets, we ask ourselves, would we want to own it? And is it liquid, right? So if we have to take over the keys, which is not a likely, not a scenario we want, we're not predatory. We always want this to work out for our borrowers, but we always have to think about our downside. And so those are the key questions that are constantly asked internally. Would we want to own it, and how quickly could we liquidate it? And then credit enhancement. In addition to having the first lien on these assets and these properties, we get personal guarantees from our borrowers in order to further enhance the credit and our protection, and making sure that not only we don't really chase the big sexy net worth numbers. It's really making sure that the borrowers have the liquidity, that to free it up if something were to go south or be in jeopardy.
Hi, Bo. We have a question.
Hi. Okay, perfect.
It's about loans. Mary's asking, approximately how many loans do you have at any one time?
Right now, it is six. And I can go into that on our active portfolio slide. But at the moment it's six.
Thank you.
You bet. So what makes us different? I'm not going to pretend to say that every single section in this quad makes us different. I think there's certain things in here that do make us different, and I think there's certain things in here that others do. But I think the combination of these six things are really what do make us different, and I think uh, we stand out compared to other investment firms, not just in the bridge loan space, but other space. And I'm not again saying that we're completely unique, but we'll kind of go through this. So on the execution side, when we find an opportunity that we want to pursue and we end up closing on the opportunity, 100% of that capital that goes into the deal is from our general partnership. So we close with the general partnership money, and then we end up raising capital post close, typically around 2 to 3 weeks later. Quicker liquidity, you're dealing with very short investment horizons, right? Our typical loan terms are anywhere from 12 months to 24 months. So it's not the same thing as the stock market where you can sell stock and then get same day liquidity, or money markets or treasuries, which are either same day or next day liquidity. But relatively short timeline. If you invest in an opportunity of ours and then you need that capital down the road, you can tap into that within that 12 to 14 months. The monthly income, I think I've talked about this 3 or 4 times. One of my favorite things, our investments do kick off that monthly cash flow. Skin in the game. So this one, I think, is a big differentiator. To date, over 50% of the capital that has gone into our transactions has been from us. So we always have the most skin in the game in our transactions. And I think psychologically that's very important, because even with investors, you never want their money to go, sideways. I mean, I would obviously take that very personally, but on the front end, when you're thinking, okay, I need to, going back to execution, we're going to execute and put 100% of our dollars into this. And what if we don't raise a single dollar on the back end? Well, we're going to stay in the transaction, right? Because we've already closed. So, we think about things with our own dollars. We think about things with our investor dollars. And, like I said, to date, it's been over 50% of the capital going into our transactions has been from us. Reporting and transparency. So I alluded and spoke briefly about the other groups I was working with that were in the private credit, private lending space. The returns were fine, right? And I think I never really had an investment that went south or lost money or anything like that. But what bothered me is that I didn't really have any visibility into what my money was doing, right? So there's the good, there's the bad, and there's the neutral. And I would receive this money every single month in my bank account. I would see my distribution notices, but I didn't ever know, hey, is anything in my portfolio at risk, right? Or is anything in my portfolio, potentially at risk? And so this is one of the things I really wanted to do better at Pine Peak, was be very thorough in our reporting and our transparency with our investors. When we hold our monthly asset calls with our borrowers, we do this via Zoom and we record those. And when we do that, you hear the same thing that we hear, right? So we take those recordings, we put them into the investor portal, and you hear exactly the same thing we do. Sometimes, I mean, they're completely unfiltered. Sometimes you might, hear a swear word from one of our borrowers, right? And we're not editing that out. We're not changing anything, because they're designed to be completely unfiltered and be completely transparent. And so, and then you receive monthly investor reports from us as well. And so I did, in the virtual room, I did give Chantal some samples of our reports. I didn't load any of the asset calls into there, but you can see what like a sample investor report looks like from us on an ongoing monthly basis. I think it was 3 of them on 3 of our different assets. So you can take a look at those. Then competitive returns. So, we're obviously underwriting these things for a 12% plus net return to our investors, again, with that underlying downside protection there. So this is our active portfolio. These various assets are at the moment, they're all centrally based, right? So we have a couple different multifamily assets. We have a piece of land. We have an industrial building, and this one at the bottom middle is Buckingham. It's a parking lot in downtown Chicago. But what I mean with centrally focused, three of these are in Texas, two of these are in Chicago, and one of them's in Oklahoma. So, that's not by design. We definitely will go, northeast, lower east, northwest, out west. It's just at the moment it has been kind of centrally time zone focused, if you will. So I think this will answer that previous question. This is our currently active portfolio. Team and founders. So I think this is a good visual. I think it's important for people to know where our team sits in the overall funnel of our process funnel. So if you look at the top, we have deal sourcing. So where do the deals come? That's Ethan Cranley's job. He's our VP of originations. He feeds the top of that funnel. And is there a question, Chantal? Sorry.
Yes, there is.
Yeah, go ahead.
When do we exit the investment? 3 years or 5 years?
No, so going back to this slide, which one was it? So if you look at the quicker liquidity, it's around 12 to 24 months. So, inside of 2 years. Sometimes it can be less than 12 months, but we have designed these to have a prepayment penalty. So if our borrowers, let's say, want to do a 12-month term, we'll typically bake in, 9 months minimum interest. So if they take us out earlier than that 12 months, it's great because it enhances the overall IRR on the time perspective. And so, but typically, it's around 12 to 24 months.
Great. Thank you so much.
You bet. Okay, back here. So yeah, Ethan feeds the top of the funnel, bringing in the opportunities for us. You have Ryan Ward, he sits really in the diligence and underwriting process. The guy is brilliant. He's a wizard when it comes to this stuff, and really, cuts a lot of the fat. We do have, it's about a 96.5% kill ratio. So, we dislike more than we like. And Ethan brings the deals to Ryan. He's involved in diligence and underwriting and screening on the front end as well. But Ryan really takes fine tooth comb to these things and ticks everything out to make sure everything's up to snuff, that we have a good economics in the deal. And
Bo, can I take you back to another
Yeah,
question?
bet.
Sorry. Actually, there's a couple that have just popped in here. So let's first out. Eddie would like to know if you could talk about the returns. Are you looking at 10%, 12%? Can you speak to that?
Sure. Yeah. So going back here, so returns bottom right, we underwrite to try to get, we shoot to get the investors a 12% net return. That's the goal. And I had mentioned before, that's in today's environment. Obviously, rates are a little bit higher. It could come down, but they could even go higher. Who knows? I mean, if banks aren't supplying liquidity, there's going to be more of a need for bridge lenders, and our rates could stay the same or may even go up just because money's tighter. But in today's terms, it's been 12%.
Right. And, just another question here from GS Castleman. And do you expect this to be an evergreen fund?
Yes, it is in many ways. So we are a fund, but what's important is that investors can pick and choose which opportunities they want to be in. So it's not a blind end fund where, let's say, you wanted to invest $100,000 into us, and we spread that out across 4 different assets, 3 different assets, 2 different assets. It doesn't work that way. You specifically get to pick where your money goes. That was important for me too. These closed-end funds, I'm not saying there's anything wrong with that. It works for a ton of people, but it's my preference to know exactly where my dollars are going, because you could be, whether it's private equity, private credit, you end up investing in them, and then you see after the fact that you're invested in maybe 4 or 5 of these things you didn't want to be in. It's too late, right? Like we want our investors to know exactly where their dollars are going. They like one, they don't like one. They can invest in one you like, the one you don't invest in one you don't like.
Thank you. That's great.
Yeah, you bet. Okay, just really quickly go. I think we have 5 more minutes. Going back to execution, so that's mainly me, but I mean Ryan and Ethan sit on this too, right? So, but I effectively decide if we're going to move forward on a transaction, if we're going to deploy that capital, and I'm kind of in that lower end of the funnel here, so I have the veto rights whether we end up pursuing a transaction or not. So execution, it's everyone on our team, but it's kind of mainly where I sit. So, and then you have the capital providers. So there's myself, Eric Nordyke, Corey Baggett. These are the two gentlemen I was talking about at the beginning who I've had my business career with. Corey and Eric are members of the board. They're not necessarily as active as me, Ethan, and Ryan, but they also, they have a say in our transactions. They obviously provide capital in our transactions, and they're part of the general partnership. So that is it. Anyone have any questions? Any more
Bo?
questions, I guess? Yeah.
No, there's no more that have come in at this moment. It doesn't mean that they won't submit a few in just a second here, but
Yeah.
I always, when we have a few minutes, I always ask our presenters to, what are the top two questions that a new investor might ask you if they were considering your opportunity?
Yeah. Well, they always ask about the protection, right? And I covered that, and we having the first lien, having the proper collateral, and I think another thing that they will ask is, where are you finding these opportunities? And they come from all different places, right? I mean, we find them on our own by pursuing, direct borrowers. We find them sometimes from brokers, and we also get them from banks, right? So if you think about that bridge scenario here, like how to and how this works, a lot of times banks will see opportunities that they like, but it's just not quite there, and it's really close. It's a bankable deal if they maybe need more time, right? They need to improve more time, and or maybe they need to kick off a little bit more occupancy or NOI. They'll often bring opportunities to us because they say we'd love for you to step into this for a year or 2 years, whatever, to prove out the plan, and then we will be your takeout. So we'll take you out, once these things happen. And bank referrals are amazing. So I mean, they come from many different places, many different forms, and obviously that's kind of the hat that Ethan wears on our team.
So when speaking about your properties, again, GS Castleman is now asking if they have to pick a specific property, what guidance do you provide to them as best choices? What type of guidance do you provide
Yes.
them?
So the first step is to really speak to the investor and see what it is that they're looking for, because for an example, and what characteristics they're looking in their investments from a protection standpoint, right? Our returns are pretty much the same for all of our transactions, give or take 50 basis points here and there. But some things that matter to folks is they care about the borrower's liquidity. Something that matters to folks is they want an extremely low LTV. For example, one of our investors, he ended up passing on our latest transaction, which is a totally stabilized multifamily transaction. But the LTV was too high. The LTV was approaching 70%, and he likes things that are sub 50%. So it's not a one size fits all with our investor base. They really some things are more important to them. Some things, another example of an investor, he told me, if there's cash coming off this thing, then I'm in, right? But things that don't have cash coming off them, then I'm not really wanting to do it. So it's really just understanding that investor and the characteristics that they're looking for and the types of investments.
Okay, and when speaking about funding a new deal, Ed is asking what percent is PPP's investment compared to the other investors.
Yeah, so it really, so we try to keep 50% of the capital in each of our transactions. Again, so we have the most skin in the game. That being said, if there is an overwhelming demand, for example, I'll show you this one. So that Buckingham transaction in Chicago, that one ended up being a little bit over 30% of our capital going into that transaction, just because there was an overwhelming demand. We wanted to make room for investors that wanted to get in. And so, but the average is, it's over 50% that we have in each of our transactions.
That's great. Thank you. This was a very informative presentation. You have a number of comments where people have said it was an excellent presentation. So I'd like to pass
Awesome.
that along. We appreciate you being here, and we have Thanksgiving coming up fast and furious. So happy Thanksgiving, Bo, and we hope to see you at another Money Show event.
You too, Chantal. Thank you so much. And thanks
right.
everyone for joining.
Ladies and
All right.
gentlemen, thanks for joining us. We look forward to seeing you in the next presentation at 1 o'clock.